What is retirement plan arranging? Identifying your long-term financial objectives and risk tolerance is the first step in developing a retirement strategy. The next step is to begin taking steps toward achieving those objectives. The process can begin at any point in your working life, but the earlier it starts, the better. Identifying your sources of income, adding up your expenses, implementing a saving strategy, and managing your assets are all steps in creating a retirement plan. By assessing your future income, you can decide whether your retirement pay objective is reasonable. A retirement plan is not a fixed piece of paper. You will have to refresh it periodically and survey it to monitor your progress. What is a retirement plan? A retirement plan is a guide to an agreeable life after work. It involves saving up enough money to afford the lifestyle you want in the future. While your retirement strategy may evolve, the earlier you begin, the better. 0 seconds or 2 minutes, 30-second volume, 75% essential. Tips for saving for retirement. How retirement planning works. A retirement plan is to prepare yourself for a comfortable life after you have finished working to pay the bills, or at least finished working a full-time job. However, it is not about cash. The non-monetary perspectives incorporate way of life decisions, such as how to invest your money in retirement and where you will reside. The holistic approach retirement planning takes into account all of these aspects. The objectives for your retirement plan will change in the center over the long haul. Right off the bat, in an individual functioning life, your commitment to retirement reserve funds might be unassuming. The reward is investment growth for more than 40 years. During the center of your vocation, when your pay might be at its pinnacle, you could set explicit pay or resource targets and move towards accomplishing them. When you reach retirement age, what financial planners call the distribution phase begins. You have stopped contributing to your retirement accounts. Indeed, you reap the benefits of decades worth of investments. Some retirement plans change depending on where you are. The US and Canada each have frameworks for working environment supported plans. The amount you have to resign, your enchanted number, which is the sum you want to resign easily, is exceptionally customized. Yet dependable guidelines can give you a rough idea of the amount to save. Individuals used to say you want around $1 million to resign easily. The 80% rule indicates that you must have 80% of your current income to live without problems after retiring, which other professionals use. So if you made $100,000 yearly, you would require reserve funds that produce $80,000 yearly for around 20 years or $1.6 million. According to others, most of us are not saving nearly enough to meet those standards, and we should adjust our lifestyles accordingly. Estimating cost. Your magic number is determined mainly by your post-retirement cost. Creating a retirement budget with estimated cost for housing, health insurance, food, clothing, and transportation is a good idea. Furthermore, since you will have all the more spare energy on your hands, you will need to consider the expense of amusement, side interest, and travel. Although it may be challenging to arrive at precise figures, a reasonable estimate will be helpful. Moves towards retirement arranging. Despite where you are throughout everyday life, a few critical advances apply to nearly everybody during their retirement arranging. Some of the most common ones are as follows. Concord and arrangement. Concord and arrangement. This incorporates choosing when to begin saving and when to resign, as well as how much you want to put aside for your objective. Conclude the amount you will save every month. Utilizing programs allowances removes the mystery, keeps you on target, and removes the impulse to stop or neglect to store cash alone. Pick the correct words for you, correct records for you. Put resources into 401k or competitive record, assuming your boss offers that choice. Assuming the organization provides a business match and you don't join, you must offer cash. Whether there is a business match, you get a decent arrangement charge-wise. Make adjustments and periodically check on your investments. This is especially crucial after a significant event such as a wedding or a baby. Retirement plans. Charge advantage retirement reserve fund plans have become the cornerstone of Americans' long-haul reserve funds. Depending on your life, one or more plans should be available. Each has its standards and guidelines. BOSS, sponsored plans. Most large organizations offer their employees 401k plans, and philanthropic businesses have comparable 403b plans. The direct advantage of these certified retirement plans is that your manager can match your contributions to a specific sum. For instance, assuming you contribute 3% of your yearly pay to your arrangement account, your manager might match that sum. Keeping the aggregate in your retirement account alongside your commitment. You can contribute more money than your employer will match. A few specialists suggest contributing as much as 10%. 401k cutoff funds. The greatest is overhauled yearly by the IRS. In 2024, members can contribute up to $23,000 to a 401k or 403b, a portion of which might be added to it with a business match. Individuals over 50 can contribute an extra $7,500 yearly to compensate for the lost time commitment in 2024. These records can produce a much higher pace of return than an investment account. The assets in the record, on the off chance that they are customary record as opposed to Roth accounts, are only burdened once you pull them out. You will get a quick personal tax cut since your commitments are removed from your gross pay. Problem of a higher expense section should seriously consider contributing to the point of reducing their duty responsibility. Customary individual retirement records, IRAs. The customary individual retirement records, IRA, is like 401k plan. However, it can be obtained at practically any bank or financier. It is primarily for self-employed individuals and others who do not have access to a 401k, but anyone who makes an income can invest in an IRA. The cash you save in IRA is deducted from your pay for the year, reducing your available income and thus your assessment obligation. The tax cut to this sort of record is forthright. So when it comes time to take disseminations from the record, you depend on your standard duty rate around them. However, keep in mind that the money grows tax deferred. No capital increases or profit burdens are evaluated on the equilibrium of your record until you start making withdrawals. I can go on forever on this retirement plan. I want to stop it here because the video is getting too long. I hope you like this video and can make the best use of it for your retirement plan as well. Thank you very much for watching my video. Please do not forget to subscribe to my channel. Thank you. Bye for now.